Royce Mendes is with us now from CIBC. Royce, great to have you with us. And let's just start with sort of what you're thinking about. And I know we can look, we could say 2024 is going to be great, but realistically, as you look kind of to when we actually expect to see traction, what are you now thinking?
Well, if we base our outlooks on what public policymakers are telling us about the vaccine rollout, we could start to see growth showing up in the not so distant future. Maybe March, we start to recover some jobs. In the second quarter of this year, we start to build some momentum and see a quarterly growth rate in positive territory. And then by the second half of the year, we really get rolling. And I've been calling this a potential for a rubber band type of rebound.
And in terms of the groups that will lead us higher, give me your thoughts on, we do know that there will be pent-up demand here. What will lead when we can get out and spend again, when things reopen? What are you looking for?
So in terms of pent-up demand, everyone is focusing on whether or not people are going to go out and have dinner at a restaurant 5 nights a week or have 3 haircuts a month. But that's not really the best way to think about the pent-up demand that is going to be satisfied with all of the cash that has been built up in the savings accounts of Canadians. I would argue some of that is going to show up, but a lot of pent-up demand is going to come in the essential or near essential services that were deferred. So what I'm talking about here are surgeries, medical procedures, even just regular health checkups that people didn't do during the pandemic because they were really afraid of leaving their house. That's going to happen. That doesn't rely on people spending extra money. Actually, a lot of that comes from public health insurance. There is also deferred maintenance on houses, cars, even just going to your dentist. That does rely on Canadians spending a little bit more money, but that is near essential. And we could see that deferred spending occur over and above the typical cycle for spending on things like surgeries or medical checkups or dentist appointments or maintenance on autos. And that's where you can see sort of an extra layer to this gradual normalization that we see happening in the Canadian economy. Now, you and I have discussed this before, that during the pandemic, Canadians were buying a lot of goods, and that was leaking money out of the economy through imports. Now, as we gradually normalize, even just the normalization of spending patterns towards more services, where more money is kept within Canada, that's going to give an extra boost as well. So I think, some of the bearish views on consumer behavior are missing a lot of key points here. It doesn't rely on Canadians going out for dinner 7 days a week.
And you do see a pullback in goods spending. How much of a drag effect? Because we have all, presumably all the spending that we are doing now are things that we are pulling from the future to some extent. So what sort of effect does that have on us as we do try to rebound?
So look, for the rest of this year, we actually see from the second quarter to the fourth quarter, goods spending actually declining outright and moving closer to pre-pandemic levels. But that is absolutely swamped by, as I said, the gradual normalization of services spending. Then over and above that, a little bit of indulging in some discretionary spending. Maybe someone goes out for their first manicure. They built up some savings. Other people go out for dinner a few more times per month. And then that deferred services spending. And that is far more than what we see in the pullback on goods spending. So overall consumption is growing this year by a quite healthy margin. What
do you think is the biggest risk to our economic outlook? And I say that obviously, Royce, the biggest risk is staring us in the face every day. It's that the pandemic doesn't get under control in a way that allows us to grow. But beyond that, what do you think? Is it inflation that could rear its head? Is it the U.S. economy not rebounding strongly? What's on your mind?
It's funny, when I think about inflation, I think maybe there are some pockets of inflation as business capacity is constrained this year, but services spending really picks up. But that's temporary. What we learned from last year, and this is maybe one of the few good pieces of news from last year, was that businesses actually opened and reopened at quite a swift pace after March and April. And if that happens again, some of the hardest hit industries, restaurants and bars, were reopening at an even faster than average pace. If that happens again, we can get capacity back online, and those inflation pressures should be temporary. If I think about, as I said, business closures, there's certainly a risk that this latest wave of COVID leads to more scarring. But again, I look back to last year, and those reopenings give me some sense of optimism about this year. I think you hit the nail on the head. It's not really about the economic fundamentals about what a rebound will look like. We sort of have a good sense about that. The risk here is on the virus and whether we can get this rollout implemented at the sort of pace that the federal government is expecting in Canada. That is absolutely key. And then maybe a risk that's further in the tails is that some of these mutations of the virus require a reorienting of the vaccines that could take a few months to roll out. Those are the delays that we're worried about. And you can tell that news on those fronts is what is really driving sometimes the daily risk-off sentiments that we've seen over the course of the few trading days in 2021 so far.
I do want to drill into something here, and I know we've talked about it before. I feel like we'll talk about it again, but that is that because Jay Powell referenced it today, and that is that non-financial delinquencies have not risen. We have seen this kind of holding pattern in bankruptcy rates, and we have this feeling that people are kind of hanging on, some by their fingernails, but hanging on. Royce, do we worry? How do you factor in, or do you just need to wait for it to happen if it's going to happen? This idea that when this is over, the tide will go out and it'll expose a lot of people.
That's right. I think that's sort of baked into our forecast, and that's probably baked into a lot of the market forecasts. You can see banks have made provisions for these sorts of losses. They haven't shown up just yet. That's because, for either because of government support or delays in filing for bankruptcy or things like that. But we do expect that to happen. That's part of the forecast. And we know that the first quarter of this year is going to intensify those pressures. But the reopening of the economy, and that's why this trade is so strong, is such a big tailwind to the economy that it can heal a lot of those wounds very quickly. And again, and that's why I come back to it, it is how fast we can get to that reopening point that will dictate where we are in the level of GDP a year from now, how many jobs are recouped a year from now. Hopefully, in our base case scenario, which we outlined today in a new forecast publication, we get to the pre-pandemic level of GDP by the end of this year. Businesses that went bankrupt, households that couldn't hold on were, over the course of time, that effect was repaired in terms of the overall economy over 12 months or so. Similarly with employment, businesses that went under and people who lost jobs, the private sector of the economy really starts to pick up as you can reopen. But it all hinges on this reopening.
Royce, it's great to have your thoughts. Appreciate it. Royce Mendes, senior economist, CIBC Capital Markets.